Hi, my name's Sam Hakura. I'm the founder and chief investment officer of Alphyn Capital Management. I try and help successful individuals and families invest their portfolios in a way that aims to preserve and grow their wealth for the long term. Importantly, I put about 70% of my personal money into the portfolios I recommend for my clients. And I think this demonstrates, one, high conviction, and two, very high alignment with my clients. And I think those two things are important. So synthetic leverage. I've used synthetic leverage to describe when a company employs someone else's resources, like capital or operations, to generate additional income. The best example of this is Warren Buffett's use of insurance float at Berkshire Hathaway. He used the money from insurance policies to invest in stocks and buy businesses. In other words, he borrowed money instead of using his own resources. As you know, borrowing money to make investments, otherwise called using leverage, can be extremely risky. If your investments lose enough value, the bank or brokerage can force you to post up margin, which is another way, say, of putting up additional collateral. Or they can call the loan entirely, and they can do this at the worst possible time, forcing you to realize a catastrophic loss. Crucially, Buffett's insurance float is non-recourse and non-marginable. No one can force him to pay back the loan. So while he still has to make suitable investments, he can be much less worried about catastrophic drawdowns, the kind that has happened to many intelligent and sophisticated investors over time. An example, long-term capital management in 1998, which was run by two Nobel laureates no less, and almost broke down the system at the time. More recently, Archegos Capital in 2021 ran up catastrophic losses and had to be bailed out by Credit Suisse and caused them a lot of problems. Someone analyzed Warren Buffett's performance over 40 years. What they found that his underlying investments grew at 15% a year. That's a fantastic long-term track record. However, and this is the special part, with his non-recourse leverage, his returns moved up to approximately 25% per year. Over 40-something years, there's a massive difference. It's a difference between making around 250 times your money and 7,500 times your money. We're talking about very large numbers here. There's a reason Warren Buffett is so revered in the investment community. Most investors can't access these kinds of situations, and I don't use any leverage in the money that I manage. But what I try and do is to fill the portfolio with other large public companies that can use some form of synthetic leverage. I believe that focusing on companies that can take advantage of synthetic leverage can increase our chances of success and help us make more money from our portfolio. By focusing on companies with synthetic leverage, I believe it can help us get more bang for our buck. If you're interested in finding out more, please don't hesitate to reach out.